featured guest is John Lynch, the Chief Market Strategist at Evergreen Investments. John, we're going to kick things off with you. You know, Matt's been making this point really all day, and I think it's a good one. Here we've got Warren Buffett doing a huge deal, kind of endorsing the economy, and yet markets are doing not a heck of a lot. Why is that?
Yeah, it's a surprising move. I thought there'd be more of a rally based on Mr. Buffett's decision. I suspect, you know, after a 60% rally in the past 7 months, we're expecting earnings to be better than expected. That's kind of all written in already. So I think investors are just kind of sitting tight today and not responding as we thought they would, given the big news from Mr. Buffett.
You know, we have seen kind of a turnaround, John. We were talking with a trader yesterday who used to always say he doesn't care what happens, he's buying on the dips. Now he's selling on the gains. Do you think that market sentiment has turned around a little bit, or momentum has turned around a little bit?
We've certainly seen that. If you look at a lot of the technical indicators, which had been exponentially stronger than fundamentals for many of the last several months, what we've seen now, relative strength, momentum, you see a variety, or the VIX certainly going through the roof last Thursday and Friday. I think that's really indicative of people have priced in a good third quarter GDP number, and I think people priced in good third quarter earnings, and now we're kind of looking at the next 30, 45 days, what's going to move it. I do think, though, the last 4, 5, 6 weeks of the quarter, we're going to see a lot of that cash on the sidelines give one more surge for equities.
How much more cash on the sidelines do you think will come in here? Because Carol and I talk about this a lot. There was $4.5 billion in money markets, now $3.5 billion, and historically we look at a level about $2.5 billion. It would make sense to me that that level rises here in the new normal.
Right. The data I look at sees about $3.5 trillion in money markets.
Sorry,
right
trillion
now.
is, of course, what I meant, not billion.
35 or 40% of equity market capitalization, typically the ratios 20%. So I think your viewers need to appreciate the fact that all $3.5 trillion is not going to come in, but I think a portion of the excess, if you will, $1.5 trillion. And another thing that could push equities higher, the Fed stopped buying short-term, long-term, treasuries last week. What's going to happen with that? We'll have the Fed meeting tomorrow. Will we start to see market interest rates nudge higher as that money's pulled from treasuries back into equities?
Let me ask you also, John, because we've got a couple of big events going on this week. You've got the Fed kicked off its two-day meeting today. You've also got that big jobs report on Friday. Either of those, could they be a catalyst here for stocks, either up or down?
Well, we'd all hope they'd be a catalyst for up, and I suspect tomorrow may be the better of the two.
Unless you're shorting the market, of course.
Unless you're short, exactly. Looking at the Fed meeting tomorrow, I suspect they may get a peek at the unemployment numbers going into Friday. I don't want to accuse anybody of anything, but they may have some idea of how things are going to be released. I think the numbers probably come in about 200,000 jobs lost. Hate sounding cavalier about numbers like that, but it's down from 7, so that can be viewed as a positive by some investors. But I think tomorrow's news will be no news, and I think no news will be good news for the equity markets in as much as the Fed is going to continue this strategy of extraordinary accommodation through year-end, I believe, going into the first half of next year. That's when I think the jawboning really starts.
Hey, let's head to the Chicago Mercantile Exchange and bring in trader George Tkaczuk of RMB Group. George, welcome to the show. Let me ask you about the momentum change here, because it seems like even with such good news, Warren Buffett coming in and making, I guess, all in all, it cost him more than $20 billion to finish his purchase to a majority stake of Burlington Northern. We should see, I would think, more of a pop, and yet we don't.
Yeah, and that's kind of how it's been for the last 2 weeks. We've actually had some very good news. We had good earnings news coming out. We had the GDP news. This was a bit of a surprise to the market. The ISM manufacturing numbers. You had factory orders this morning, yet the market can't get a rally going. It's been a correction basically now for 2.5 weeks. So it's sort of maybe this is the correction everyone's been waiting for all summer. Maybe it's going to be a little bit longer. This morning the market tried to make a run for it and just kind of couldn't do it. The volume's low again. But it might have stabilized. At least we didn't undercut yesterday's low. Yesterday morning, after the ISM numbers, looked like the market was going to really rally. Volume just came in huge, and then it petered out at the end of the day. So again, we have this really good news, and the market can't do anything. So it's...
Does it not make sense to you, George? I mean, are you kind of scratching your head over some of the trade here?
It kind of doesn't. It kind of doesn't make sense. Meaning, in a sense, like the market's priced things in. It's been selling off towards the end of the day now for 2 weeks. So it's sort of maybe they priced all this good news in, or maybe they're just positioning ahead of the Fed meeting, ahead of the employment number. There's so many things going on. Now, another thing too that happened the last few days is the dollar traded up, and a lot of traders are looking at that today and saying maybe it finally stalled. Gold prices shot up $30 today. So again, even when the dollar was still up. So there's just a lot of this confusion. Everyone's wondering which way is the market going to go. And it looks like to us, everyone's just maybe positioning to see what the Fed has to say.
George, let me though ask you, is there any fear? Is there any drama? Is it exciting? Is it scary? Or is it kind of boring because we've had such a great rally and it doesn't seem like things are going to crash?
No, actually, it's kind of exciting because, this is the first true correction. We feel a correction. We went to cash, and now we're like wondering, should we get back in? Look at the dollar. Well, we think it's stalled. Maybe it's not going back. Oh, look at gold. So we're looking at all these things, and it's really kind of exciting, and everyone's wondering, should be the first one to step back into the market here, or should we wait on the Fed, or should we wait till Friday on employment numbers?
Hey, John, let me bring you back into this. I mean, when you do see a dip in the equity trade, and we've kind of had up day, down day, it seems like over the last week or so, those selling days, is that an opportunity for investors to kind of get in here at a little bit lower level in your view?
Yeah, John?
Yes, please, John.
Oh, I'm sorry. I thought you said George. Yes, absolutely. I think, you're seeing some people with buying opportunities. We did break through the 50-day moving average. I guess it was last Thursday or Friday, so you will see some people nibbling. A point I'd like to make about this lack of reaction, disappointment we're all feeling because of the Burlington Northern deal. We've gone from the excitement of technology 10 years ago into the financials racing higher the last several, or through 2006, 2007. And maybe this whole decision that, railroads are the exciting play now, maybe that's why the market's kind of muted. And I just suspect what we're looking at is we've been in a liquidity-driven environment, and now I believe we're going to transition into a fundamentally driven environment. And I think Buffett's hitting the nail on the head right now, looking at rails being, if you will, he's bringing sexy back to railroads relative to what we've experienced relative to many of the other sectors that have led the market higher.
Sexy, huh?
That's right.
That's a little bit depressing, I guess.
I think that's the new headline. That's the headline. Buffett bringing sexy back to railroads. John, let me bring you back into it. The gold trade. We're hitting another record here. You like gold, or the gold field, or the mining field at all?
I still like it at 1,085 because when the gentleman before us talked about the second-tier banks, if you will, yes, the dollar's weak, but we always have to appreciate that the dollar's only where it was 15 months ago. So I think until the Fed starts raising interest rates, I believe by the middle of next year, you're going to see central banks diversifying from the dollar into gold. They're not necessarily going to want to buy the euro at 145 or 150. So there's another dynamic I think investors need to appreciate. So I do see, it's always a cute argument that, you have a growing consumer market in India and China. But I think what's going to drive the price for gold will be this foreign central bank intervention. You can talk to gold bugs. They'll say $2,000 an ounce. I'm not willing to go that high, but I do think 15–20% gains from here are still achievable because of the foreign central bank purchases.
Well, a lot of it's obviously a play on inflation, insurance against inflation, hedging against inflation. George, what are you hearing as far as the inflation-deflation argument down on the floor lately? Because we were just talking about John Paulson. He's putting some big bets on inflation. Meanwhile, one of his closest advisors, Gary Schilling, is concerned about deflation. So what's the debate look like right now?
For us, it looks like inflation. Again, we're looking at the dollar. We're looking at gold prices. We're looking at a lot of the numbers in the ISM numbers, in the GDP numbers. Hidden in those numbers, if you look at them closely, there's some inflationary numbers in there. So the Fed's, it's been so easy. The Fed's never been so easy. It's just unavoidable at this point.
All right. Do you think the Fed, let me bring you into what the Fed meeting, the Fed meeting going on, two-day meeting here. So, George, do you think we're going to hear anything from the Fed in terms of inflation concerns, or it's way too early?
I think they're going to give us the usual that they don't think inflation's a problem, but if it is, they'll keep an eye on it, but they're going to keep rates low for an extended period of time. They may actually remove that last sentence. That's some speculation on that. But we just think that they don't want to be the ones that are going to be, in the future blamed for taking away the punch bowl at the party. So they're not going to raise rates. And typically, too, if you watch the Fed, what they've been doing at their meetings is talking about how inflation's not a problem. They're going to leave rates low. And then 2-3 days later, one of the governors may speak somewhere and say something like, well, if inflation starts up, we got an eye on it. So we just think they're a little bit behind the curve. We think they're trying to tame expectations by their wording outside of the meeting. But we just don't believe they'll be able to catch up to it.
John, are you concerned about what the Fed is going to do, or do you sort of think that's something that's going to happen in the summer of 2010 or later? Let's concern ourselves right now with where we can make money in these markets.
Well, no, I think George makes a good point about the Fed talking up. I think they'll keep rates steady tomorrow, certainly. I believe extended period will stay in. I think we need to appreciate the fact that if irrational exuberance were two big words that hung over our head for a while there, I think extended period are two big words that we all need to appreciate. It was just last March that we learned that the 10-year could move by 50 basis points in a single day when the Fed said they were going to purchase the long end of the curve. I believe the day the Fed removes extended period could be a similarly big day in the Treasury market, except on the other end. So I think we've got to be really careful for that. I think tomorrow they'll still placate the markets with accommodative language. But going into next year, I agree with George. You're going to see an awful lot of speeches expressing concern from Fed governors about the potential for pricing pressures. They basically want the curve to move on its own, so by the time the Fed does indeed raise, and I think they'll need to raise before the midterm elections to assert their independence to the global marketplace, at that point it can be an ancillary event.
Do you think that we're going to see, I mean, George says he thinks we can take some relief and that there's a correction right here. Do you think that we're seeing that? I mean, we're down 5% from October 19th.
Yeah, but from the inflationary fears, I don't think inflation's going to come just yet. You know, we're going to see potentially a 10 handle on the unemployment rate on Friday. The price for our largest asset is deflating. Energy prices are 50% below where they were a year ago. I believe that's the bet that Geithner and Bernanke are making right now, because one of the best shell games around right now is that we are in a deflationary environment. Now, the pressures that George had been highlighting, yes, in 2010 we may be negative 1% deflation this year on headline inflation. Maybe we're 1% growth next year. Now, one could view that as a doubling as an inflationary threat, but someone else can say, well, it's still 300 basis points below long-term historical pricing pressures. So for that reason, I don't know if we'll necessarily see true inflation, if you will, 4% average that we've experienced since World War II. We may not see that until 2011.
All right, we're going to leave it there. Listen, guys, we appreciate your time. John Lynch and George Tkaczuk joining us on this Tuesday.